Good morning and welcome to the Prescient Investment Management MultiAsset update for Q3 2023. My name is Samantha Petty and I'm joined today by our CIO, Bastian Teichgreeber, and our Head of MultiAsset, Rupert Hare. As we head into the fourth quarter, let's take a look at the future. Basti, can you take us through what macro themes we're expecting to see towards the end of 2023?
Yeah, sure, Sam. Thanks for having me, everybody, and thanks for joining. So we are quite optimistic, remain quite optimistic for the last quarter of this year. So we expect global growth to actually re-accelerate, as we pointed to earlier this year. So not seeing this hard landing, not seeing this soft landing, actually seeing no landing at all, which actually is good news and means that within South Africa we can leverage off this global growth to get some positive news into our economy as well.
And can you give some examples of where you see global growth actually going?
Yes, exactly. So I would like to break that down a little bit detailed for you. So we always like to look at global growth. In this instance, we once again focus on US growth by looking at the Prescient Economic Indicator. The Prescient Economic Indicator is our own in-house nowcasting tool. So it's a model suggested by Stock & Watson, which we use to basically track the US economy in real time, and we're measuring it against trend growth. So what I'm going to do is I'm going to zoom in a little bit to focus on why I just said that we see the US economy re-accelerating. You can see that we're not seeing a deep dip like we've seen it during great financial crisis or during COVID here, but what we can see is actually a quite shallow dip just below trend growth. And then this slight re-acceleration, dipping off a little bit, but we're hovering around trend growth again. So trend growth is not zero. So with that, if I now look and what kind of analyze what exactly it means, you can see in this chart the red line is the nowcasted GDP from the Prescient Economic Indicator. The blue line is the actually materialized GDP prints. So what you can see on the right-hand side is the Prescient Economic Indicator still is suggesting a current growth rate of 2.6%, and you can see in the history of that chart that it has actually been a quite good predictor of US growth. So let me do one final chart on that. This is a simple regression line between the Prescient Economic Indicator on the x-axis and real GDP on the y-axis. And what you can see, first of all, there's a quite good match between the two series. So the Prescient Economic Indicator is a good predictor. But then also, if I just basically slice that regression line at the current level, you're getting to this 2.6% growth rate, which we are expecting to experience as we speak.
So higher growth means higher inflation and therefore higher rates. But we've been saying that we are expecting inflation to go down. Have we been wrong? Because, it seems like inflation is easing in the US and in South Africa, but the Fed has come out with a rhetoric of higher for longer, whereas the SARB has come out with a 3-2 split vote on whether to hold or to hike. So should we expect to see future rate hikes, and why would this time be different?
Yeah, so good point again. Quite a few questions in one, I guess. So I would agree that partly in the past we potentially have been wrong on inflation. We expect inflation to come down much quicker than it actually played out. And nevertheless, eventually inflation did come down quickly, and it came down for exactly those right reasons which we anticipated, which is good. So does higher growth now mean more inflation? Not necessarily. So we think that there's a lot of deflationary forces actually playing out right now, which ease the pressure of inflation. We have in the last webinar decomposed the US housing market quite detailed, showing that with the shelter component coming down because of the housing market being weaker in the States, a lot of the inflationary pressures will actually disappear. So from that point of view, we are headed a little bit for a Goldilocks scenario, like positive growth, but inflation coming down. Will the Fed now continue to hike? We don't think so. The Fed is not really in the need for further hike, but the bad news is the Fed is also not in the need for any further cuts. Okay, so why am I saying that? With higher growth, inflation can still come down and the Fed is not hiking. So what we're showing on this chart is pretty simple, just US CPI. And you can see that inflation came down rapidly all the way down to 3.2. Now we see a little bit of a re-acceleration. That's not really worrying us because I don't really want to call this a re-acceleration. If we decompose inflation, we can see that once again the scenario which we anticipated is actually playing out quite nicely. So you have motor fuels, which had a significant negative contribution, that the oil price, which moved up to now just a marginal negative contribution, which is going to be eventually a positive contribution, and that's driving top line inflation. But all the other core elements of inflation have actually continued to drift lower, and it continues to just be this shelter bucket which stands out. So I'm not going to decompose the shelter component too much in detail in this webinar, but I do want to highlight one or two things more when it comes to inflation and also core inflation. So again, this is just US CPI on the blue line, US PCE in the red line, and then we've got PPI, which is producer price inflation, which is more oil driven or energy driven or commodity driven in general, which has reaccelerated a bit, pulling up CPI and PCE. Okay, so that's why we shouldn't be too worried about top line inflation. And if we now take this one step further and look into core inflation, what we can see is that core inflation continues to drift much lower. So again, this is core CPI, core PCE, and core PPI, and they're all actually coming down. So a little bit of a rebound short term because of the reacceleration of the oil price, but structurally everything in a good space and everything on its way down.
Thanks, Basti. So now let's not only look forward, let's also look back at some of the key themes we've seen this year. And we've spoken previously about a potential global banking crisis, which we know came about due to the US regional banks and the global Credit Suisse bank sowing doubts among market participants with regards to the solidity of banks. How did this actually play out?
That's a good point. It's always good to also look back and not just forward, and also basically check on ourselves whether our predictions came true. So on the banking crisis, our take has always been that the Fed was very fast to move and to basically provide the market with a lot of liquidity. And with that, the banking crisis, in our view, was resolved quite quickly. We also highlighted that the default, for example, of Silicon Valley Bank was really not linked to anything systemic. A lot of internal control mechanisms which had failed. And Credit Suisse, again, wasn't really linked to Silicon Valley Bank at all. Same story. Got taken over eventually, and with more liquidity in the system, the Fed managed to basically eradicate this crisis quite quickly. So we still do see quite a few smaller banks defaulting, which is interesting. So there's still some horror charts out there, but we simply don't think it's systemic. And so to understand the banking crisis best, we like to look at the balance sheet of the Federal Reserve, which basically is depicted in this chart. And when the banking crisis broke loose, so to say, we could see the small spike here on the right-hand side. And I don't want to downplay it, but it's really not a massive spike. And also we have immediately afterwards continued the trajectory of a shrinking balance sheet, i.e. the Fed still succeeds in taking money out of the system. So let's look one step deeper and really decompose the balance sheet by looking into all the individual components which are held by the Federal Reserve. So the big red area and the big yellow area, those are the core holdings, those are nominal notes and bonds, so basically T-bills and T-bonds. And then basically the yellow area was mortgage-backed securities. So if I switch everything off and now just bring back that small component, which is the loans facility, that's a facility which is utilized in circumstances of emergency. So that's basically the emergency funding which is provided by the Federal Reserve in billions. So when we had the Silicon Valley Bank default, we were very quickly to supply the banks with $354 billion of emergency funding, and it was taken up. So at that point in time, we must say it potentially was a banking crisis because it was a severe, basically drying up of liquidity and a severe liquidity need, which was taken up by the banks in the States. But what we could see after that is that as we move on, and especially over the last weeks, the need for this program has come down remarkably, and almost 50% of the loans which have been issued on the back of this emergency have by now been repaid.
Thanks, Basti. So now to connect some of these macro themes to our positioning, Rupert, can you take us through what's on your radar for the fourth quarter and how our funds are positioned to take advantage of some of the opportunities that might arise?
Yeah, absolutely. So we at Prescient are all about diversification. What Bastian's taken you through is a lot of macro indicators. All of those play in some way, shape or form into how we position the portfolios. And for us, it's about diversifying not just across asset classes, but across geographies. So both South Africa and into global assets, including emerging markets. So let me take you through some of our views on asset classes. Right, so if we look at our overview on asset classes, As a reminder, how this works is that when we're in the middle at neutral, we've got no particular view on asset classes in the tactical sense. We will, of course, have structural weights towards asset classes. So, for example, South African equities, currently we don't have a view, but we have a structural weight within our portfolios to South African equities, which leads me into, I guess, the theme that we're seeing within the equity space. SA equities at neutral. The majority of global market equities are at moderate negative, so no real screaming buys or sells here. And just taking you into why that is, South African equities is actually much the same case. We've had a strong valuations for quite some time, but arguably it is a bit of a value trap. Why do we say that? It's because things like economics and financial conditions are not supportive towards a strong growth profile in South Africa. The last one, sentiment. That's something we feel is very important within investment management. And in South Africa, we are seeing sentiment which is below zero. In other words, pessimistic themes within the markets. And that's holding back South African equities. Just to contrast that with US equities, we still see this massive value overvaluation within US equities. Currently sitting on PE ratios, if we just dig a little bit deeper into these valuations, PE ratios which are sitting of around 24 times, which means that there are two ways that you can get out of that. Either you can grow your underlying earnings by 24%, or you can shrink your prices by 24%. So two scenarios, which the latter of which we don't want to happen, the former of which we would like to happen, but that assumes that prices remain constant. So what we need here is a very strong growth case for US equities to grow back into the fair value case that we see. Bastian did take you through our Prescient economic indicator. We are seeing an emergence of growth within the United States, but it's nowhere near that hyper growth environment that you would need to grow into a fair value type market. Switching into the fixed income space, on the South African bonds, what we're seeing here is a strong positive. We're seeing extreme value within the South African bond space. The payoff we're getting towards the back end, currently around 13%. In nominal terms. Inflation coming in, that means that in real terms you're getting a higher and higher real yield on SA bonds. The headwinds thus far year to date in SA bonds have been more global based, so a risk-off environment, in particular for fixed income like instruments, and then also related to the Rand. So the Rand sitting at a moderate positive at the moment, sitting over here, and that's because of the strong sell-off that we've seen in the Rand. It doesn't mean that we are at a strong positive. On the Rand, there are still some significant headwinds, those being the similar headwinds that we see in South African equity space, namely sentiment looking pretty poor on South Africa as a whole. But we are looking at that as a trade potentially to put on some currency hedging or additional currency hedging to protect us against Rand strengthening back from 19 all the way down to, let's say, a level of 17.50.
Thanks, Rupert. That's really interesting. So what does it actually mean for our multi-asset fund positioning?
Yeah, so I mean, those views translate directly into how our multi-asset funds are positioned. So let's look a bit deeper into how both the balanced fund and the defensive fund are positioned at the moment. Okay, so looking into how the balanced fund is currently positioned, we don't have many strong positions within the allocation, so we're pretty much on the strategic asset allocation, that being a strong mix between South African and global asset classes. If I switch into how it's currently positioned, you can see that we're pretty close to that, so sitting at around 25% SA equities, diversifying a lot of that offshore into the global equity space. I want to talk about this a little bit more in a bit more detail at a later stage, but we like to diversify these portfolios. And then within the fixed income space, we switch both onshore and offshore. In the bond space, we've got an allocation towards SA nominal bonds over inflation linkers. And then we've also got allocations to clean energy and infrastructure projects, which are offering us very attractive CPI plus targets at the moment with a very stable return profile. Looking into the defensive fund and how that's positioned, this is a much lower equity allocation. The majority of that equity sits offshore. We have a small slice towards South African equities, much more preference towards the more diversified global developed and emerging market indices for the purposes of single stock diversification. But in this portfolio, what we have in SA in particular is a higher allocation towards the nominal bond space. We've got 5% and 5% towards clean energy and infrastructure. We've also got some positioning towards the front end of the curve in the income space. offering also a very attractive yield profile at a very, very low volatility. And then offshore, we've got, again, a mixture of developed market bonds and developed market income to diversify across the yield curve within global fixed income markets.
Thanks, Rupert. So I see that you're quite strongly positive on bonds. Can you explain what that means for your fixed income asset allocation in your portfolio?
Yeah, so within the fixed income components, we've got two levers. One thing is we can add rand exposure, and the second thing is we can add duration exposure. We lean a lot on the fixed income team at Prescient for that. So let me take you through one of the models that we use to allocate towards bonds in the South African bond space. So our SA bonds model allows us to position the portfolio across the curve to the different issuances from the South African government. And what we see here is different scenarios. So at the moment, as a reminder, we're in strong positive, which means that we're looking to invest in a scenario where bonds perform in a strong positive environment. If we were to switch this to, for instance, a strong negative, you'll see there are different scenarios that play out across the yield curve. But just switching back to strong positive, what we see here is in a total return, expected return perspective, we see value towards the midpoint of the curve and not much more value in taking exposure towards the back end. So how the balanced fund and the defensive fund are positioned is round about this sweet spot where we're getting a strong yield profile plus the ability to capture upside when our yields come in. At the same time, we're not taking on excessive duration within the portfolio.
Wow, so you're expecting more than 17% return on your bonds. Those are really attractive numbers. How do we at Prescient work those out?
Yeah, that's a good point. So it's generally, we get that question quite often actually, because it looks too high, it looks too good to be true. So the way we calculate those expected returns, exactly like Rupert said already, that we take the current yield. Well, that's what you earn if basically nothing happens, nothing changes to the yield curve, but then there are things changing, right? So what will normally happen is that you roll down the curve a little bit. So basically, if in a year's time, you've got exactly the same yield curve, but now your 10-year bond has become a 9-year bond, which is discounted at a lower rate. So which means you get a little bit of price appreciation on that. And then again, as Rupert has shown, we are strongly positive on those SA government bonds, which means we expect yields to come down. And in fixed income markets, yields come down means prices go up. So what we do at Prescient is really scientifically combine all those effects. So the carry, the roll down, the potential yield compression, which we back out empirically, the current yield, but then even the factors like secondary order factors like the convexity of the bonds, etc., etc. So without going too much into detail, the combination of these factors is really what you can see expressed in those quite high expected positive returns on our bonds.
So we at Prescient, we really do consider it all. Now, Rupert, you mentioned in the beginning something about global diversity. Can you take us through some of the shifts that our peer group is taking when it comes to offshore?
Yeah, so we've seen some interesting changes through this year. I think others will have seen them as well if they're observing the peers in detail. A lot of the peers have shifted towards a higher offshore allocation. So one of the questions that we get is, what does that mean for our portfolios? What does it mean for the peers' portfolios? Are we expecting different types of return profiles? So for us, I've said it before, but we're big fans of diversification. We want to get away from concentration towards South Africa. Not that we don't like South Africa, fantastic bond yields in South Africa at the moment, but you don't want to put all your eggs in one basket. So a lot of the peers have done exactly that this year. So what we've done is that we've built out or improved upon some of our models where we model the peers in real time. So we get the data, the daily data for every single peer's returns, and then we build factor models for every single peer on a daily basis. So just take you through a factor model. It's not a weight model, so we're not trying to estimate the weight that, let's say, peer A has to global equities. We're trying to look at the factor exposure. So to give you an example, a peer can have invested 40% into MSCI, the universe of global equities, but really the exposure that they're getting within the portfolio is 60%. Because of what they invest in that building block, and also what they invest in other building blocks. So we track that factor exposure in real time. And what we're seeing is that there has been a gradual shift towards more factor exposure to global markets, but it isn't quite as extreme as you might think. So peers haven't really chucked all of the South African assets out the window. They are still getting South African asset exposures in their portfolios.
Thanks, Rupert. So let's turn to performance. How have our funds fared over the last quarter and 2023 as a whole?
Yeah, it's been a very, very interesting year. I think this year has been all about having offshore diversification. I say that again and again, but it's very important. So those funds that took money offshore have done very, very well, and those funds that didn't have actually lagged behind. So just talking through the different markets, South African equities are pretty much flat year to date at the end of Q3. South African bonds are pretty much flat at the end of Q3, and that's because of headwinds that we've seen specifically in South Africa. Whereas global equities had a very, very strong rally, global fixed income a bit of headwinds. But if we just compare ourselves, the total performance, our balanced fund having given around 6% year to date, and the defensive fund around 5%. Compare that to, for instance, SA equities or SA bonds outright, and those are some quite attractive return profiles. So doing exactly what we're trying to achieve within these funds, to give inflation-beating returns through diversification.
Thanks, Rupert. That sounds good. Now we've looked back, let's take a moment to look forward again. Everybody's talking about emerging markets, and in particular China. What are our thoughts on this?
Yeah, it's a difficult one. I mean, obviously there's a lot of headwinds, and we've seen a lot of headwinds unfolding. But at Prescient, we think you must look at the bigger picture, look at the data, let the data speak, also look at a lot of empirical data. So let's not focus on the headlines of the last 2 or 3 months. Surely there are a lot of worries around China, and there are a lot of headwinds, but hence we are not investing into China directly with our balanced fund, and neither are we doing that with our defensive fund. We are investing in global emerging markets. And with all and yes, they are heavily driven by China, point taken, but if you look at the long-term drivers of emerging markets, why we expect global emerging markets to outperform, it is a more attractive demographic profile within the populations of emerging economies. Yes, China demographics look particularly bad, but emerging markets as a whole, the story holds. Yes, there's more potential for growth, more potential for productivity growth. Again, China has become quite developed, but again, broad emerging market, the story holds. And last but not least, also just the ability to grow. So the growth differential, even including China, the growth differential between emerging markets and developed markets is actually not particularly tight. So the long-term story that emerging markets will outperform developed markets, in our opinion, does hold. We still expect that to materialize. Becomes a tougher and tougher argument. We've got 20 years of emerging market underperformance now against developed markets. But again, sometimes looking 20 years is not good enough. Sometimes you need to look 30, 40, 50 years or 100 years. And with that, we do continue to expect long-term emerging markets to outperform.
Thanks, Basti. Rupert, are there any other big macro themes we need to keep an eye out for going into 2024?
Yeah, I think we can't ignore the elections, both in South Africa and in the United States. We don't take a political view per se, but there definitely is a heightened risk around the corner. I mean, you've got in the United States quite an equal polling at the moment between Biden and Trump. I won't say which of the two would be better for markets, but it's uncertainty, and we never like uncertainty. And then in South Africa, you've also got a degree of uncertainty with the ANC polling lower than the last elections and the possibility for coalition government. So definitely two things to look out for, and again, a reason to split your portfolios into markets beyond those two concentrated markets.
Thanks, Rupert, and thanks, Basti, and thanks to all of you for watching, and we'll now take some questions. Good morning. Thank you all for joining us today. I'm going to jump straight into some of the questions. So to start with, Rupert, SA bonds, what about the risk with the upcoming interim budget? The yields seem to indicate greater risk.
Yeah, I think it's a good question. So the yields do seem to indicate greater risk. I wouldn't say that that's 100% based on an interim budget. I think globally there's a higher level of risk. So what we're seeing in South Africa and what we generally see in SA bonds is that yields are driven by global risk more so than South African specific risk. And we're seeing risk emerging amongst global markets. But at the same time, higher yields mean that there's potentially a much more attractive asset. And that's an attractive asset for us, especially when risk comes back off, right? So if risk comes back down, say Middle East tensions start to subside a bit, then SA bonds looking even more attractive.
Thanks. So with the Rand's recent volatility, does protection become more or less expensive?
I'll go for that one. Not really. So interestingly, Rand volatility, it feels always very volatile when one looks at the Rand, but actually over the last couple of weeks, Rand volatility, implied volatility, hasn't really been on the rise, and neither has been the volatility skew. So with that option protection, doesn't really become more expensive. Also, we at Prescient pride ourselves to know how to use these instruments. So it depends on the right structure. So there's always an affordable structure as well if you really want to use options. In our balance fund and in our defensive fund, we mostly use currency forwards, which are very vanilla instruments and which are not affected by the increased level of volatility. If there would be one, they're not affected by that at all. So very, very easy for us to continue that, and whether the rand is volatile or not actually doesn't make a difference.
Thanks. So here's one. What would it take for South African assets to rally, both bonds and equities?
So I'll take that one. I think it extends on the previous answer that I had. I think that sentiment itself would need to improve, both from a global perspective and South African. And then we're looking towards the financial conditions globally in correlation with economics. So if we get a strong growth case, then risk comes back on in global markets, and then generally people will be more attracted to emerging markets, as a whole.
Cool, thank you. So there's one that says, yeah, I agree that emerging market economies grow quicker than developing market economies, but doesn't this flow through to market returns? There have been many studies in that show that economic growth and market returns aren't always correlated.
I'll take that one. So that is very true that, economic performance and market returns are not always 100% correlated. That is exactly right. Having said that, the base assumption should mean that a company's revenue to some degree is tied to the GDP or the economic growth of that economy. And if you over the long term had more growth, more GDP growth in emerging markets, that should lead to more top line growth for emerging market companies. And with that, eventually you should see stronger share returns. It's hard to argue like that. And I guess that's also why the question arises. If you have not 10, but now 20 years of underperformance in emerging markets. But again, this is forward looking. So as soon as you continue to see more economic growth in emerging markets, one shouldn't be too negative.
Thanks, Basti. So a very relevant question here. How do you see tensions in the Middle East potentially impacting assets? Should this be a concern?
Should definitely be a concern. I mean, it's big, as Rupert said earlier, potentially big risk on the horizon. Right now, we haven't really seen too much, so pretty much a non-event for markets, interestingly. We can even look into commodity prices. You would expect normally the gold price to move, but even that hasn't happened. The oil price spiked a little bit, but also actually not too much. So far, everything seems well contained. I guess the world has pretty much rallied behind Israel, which was a bit of a surprise as well, that there's less of a room for different views. So with that, it looks like, it's not going to escalate too much further. Never say never. I mean, we don't want to sound complacent about it. Obviously, it's a situation which is highly risky and we need to continue to monitor closely. But right now, the market seems to think that everything is.
Thanks, Basti. Okay, so the Fed often uses their narrative as a tool to move policy rate expectations. How effective do you think this tool is in moving the market?
I do think it is effective. It's the communication channels of the Fed have historically generally worked. I mean, they have a lot of credibility. We've seen that through the pricing, for example, of forward-looking inflation metrics, which have never de-anchored when basically moved beyond 9% inflation. That just highlights how credible the Fed is in terms of achieving of what they say. But obviously, that's not always a straight correlation. So very often, markets disagree with what the Fed is saying, and then it kind of like plays out. Either the market is right or the Fed is right? And it's not always the same. But generally, the Fed is getting reasonably close to where they want to be with their communication.
Thanks, Basti. So one last one. Rupert, where do you think fee pressures are taking South African funds?
Sure, that's a big one. And it's a tough one. I think for the industry, there's been a lot of pressure on asset managers, and rightly so. So one of the numbers I always quote is S&P. They do research around the world around fees, and in multi-asset, especially high equity, quite a similar type of fund category. So you can compare like for like. South African fee loads and the TIC sort of approach is around 1.3% in the multi-asset category. The United States is as low as 60 basis points. And yes, that does include some of the passive funds, but I think that's part of the story because the passive funds themselves have outperformed some of the active funds. In fact, most of the active funds. So it's very much part of the story. And for us, we think that we are almost ahead of the curve, perhaps too far ahead of the curve. We're pricing at 30 basis points management fee, 50 basis points TIC, so actually cheaper than a lot of the passive funds. But it's also very much about a fair share of performance. So we think that that's more than enough for us. And that leaves a lot of the performance on the table for the end investor. So I think, yeah, that's from our side.
Thanks, Rupert, and thank you, Basti, and thank you all for joining us. We hope you have a great day further, and we'll see you for the next one.